All right, with us now on the Voices of Wall Street, we have David Gandler, friend of the show and the CEO of FuboTV, one of the most talked about companies, I'd say, in the world right now. David, thank you so much for being with us on Voices of Wall Street.
Yeah, no, thank you for having me.
No, the pleasure is certainly mine. It's certainly been a busy few days for the company with earnings, the sports betting announcements. Let's talk about the company's recent performance. Obviously, strong subscriber growth,
Yep.
nearly 550,000 subscribers as of the end of the fourth quarter. But investors were a little hung up on the larger than expected losses. Talk me through the last couple days for you and just tell me where you guys are as a company.
Yeah, so I think just looking at full year 2020, phenomenal year, and I'm happy to break it down for you if you'd like to hear about it. In terms of the greater than expected losses, I think you should take that with a grain of salt. We actually took, I think it was 570 million of losses, roughly negative $2.40 on the EPS. A lot of that was non-cash. So we wrote down, we took an impairment on face bank assets. That was between 220 and 250. So, that number comes down very quickly. There was stock-based compensation that was roughly in the $50 million range. And then there was a sort of revaluation of warrants to fair market value. So a lot of that, is intangible. So if you think about the actual cash expenditure, it was significantly less than that sort of number that you mentioned.
Yeah, and I think the number that really caught a lot of folks off guard or, on the back foot was that loss you reported 247 a share, well above the expected number from Wall Street of 73 cents a share. I mean, is that kind of what you were talking about? But I think a lot of folks are also looking at kind of these licensing costs and things like that.
No, well, again, if you look at our operating leverage, I mean, we last year, 2019, our subscriber related expenses, which is, from a GAAP perspective, all of our content costs are in that line item. That was roughly 100% of revenue. In 2020, it was, in fourth quarter, was 86% of revenue. So there is operating leverage there as we continue to scale, and that's been proven out. That number that you're referring to is a net loss, which includes non-cash items as well. So if you pull out, and again, you're not going to see an impairment next year because we wrote down everything on the face bank side to just be conservative. So actually, like I said, the numbers are much stronger.
Okay, and when you talk about FaceBank, for those who don't know, that's the SPAC you merged with to go public. Just explain that out for those who don't know.
Yeah, so we went through something called a reverse triangular merger. It's similar, I guess you can call it, for lack of a better term, a SPAC, but this is a company that is a technology company with digital assets. We have the virtual rights to Floyd Mayweather and several other key assets. And so when we took over, when we reverse merged into that company, there was some technology there on the balance sheet that we didn't know if we were going to be able to leverage it. And so we started to write it down. And then after meeting with our auditors, they said, if you are not sure, then you can actually take a very conservative approach, and then you have upside. Which is what we did, and we decided to write down, like I said, I think it's around $230 to $250 million of intangibles. And so that company really focuses on virtual digital assets, and we're obviously focused on sports, but really sports subscription, live sports, and now with this wagering angle, we just didn't have time or resources to really focus on that. We just didn't think the opportunity was as strong as what we're experiencing today.
Right. And you mentioned it. You talk about the sports wagering, but let's get into that. You guys made a big announcement on the sports gambling opportunity that's going to be available on FuboTV. You didn't come on the Voices of Wall Street to announce it. I'm a little upset about that. But
talk to our. It's tough to get a call with you. So
yeah. That I'm sure, Dave. That's the problem. No. But if you could talk through what that is and what the opportunities there are, and why some of your investors are so excited about that.
Look, there's a lot to be excited about here. We have a video product. We collect a ton of data. 90% of people who bet on sports, they watch video. 96% of our subscriber base watches sports. So it's a great fit. We've done some surveys around our audience. And, roughly 22% of our audience is willing to use a Fubo sportsbook and spend $100 a month on it. So that felt like it was a strong opportunity, and we felt the synergies are even stronger. You have synergies across data, which in my opinion in the early stages is probably the most important. You have engagement and retention synergies. You have marketing synergies. You can bundle the two. You have monetization synergies. So all in, this felt like the right step for us to take to leverage what we've built. And it also allows us to further differentiate from our video peers, both traditional and non-traditional, meaning virtual MVPDs, and at the same time doesn't put us up against the largest wagering companies, because it is a more, it's an experience that's more geared to enhancing entertainment and creating more of an active viewing experience. So that's where the genesis was in that, and I feel that we're very well positioned to be able to be a leader in that particular space.
Right, and that actually leads me perfectly to my next question. Obviously, some of this, movement downward in the stock is because of the announcement of Dish and DraftKings that they've got a new partnership. You say you're uniquely positioned. Talk to me about why that is, and why it is that FuboTV, is well positioned to take on this, what seems like a direct attack from Dish and from DraftKings.
Yeah, so I mean, we have been, in this video business for 6 years, and for 6 years we've been competing with, very large companies that are worth trillions of dollars in market cap, hundreds of billions of dollars in market cap, and we continue to slowly take share. You saw what we did in Q3. We took in 11% of net additions. Q4 we took in 18% of net additions on the virtual side. I think if you stack us up against our competitors in the traditional space, all of them, the Comcast, the Time Warners, et cetera, as well as the virtuals, we came in right behind YouTube TV. So pretty solid position. In the wagering space, it's the same thing. We don't plan to go up against these guys, but of course, we are always a wild card. We were the wild card in video only. We're now going to be the wild card for a lot of folks that are in the space. And so, of course, there's going to be some tension. Again, they've validated what I've been saying for over a year. And I think we said this on our call with you, is that Fubo sits at the intersection of three megatrends, right? The secular decline of television, the shift of TV ad dollars to connected devices, and sports wagering. And there are many folks that said, what are they talking about? This has nothing to do with sports wagering. And here you have validation from a distributor and a betting company coming together to collaborate to create a more immersive experience. And I think that's great. It's great for consumers. It's great for the industry. My position is we are, as you said correctly, uniquely positioned, is because we would own the data and the technology for both. And we're also going to be regulated. So that gives us a lot of movement and a lot of flexibility in what we can do. So I'm sure you're familiar with a lot of the privacy rules that exist today. You can't just give someone their social security number and just give it to another company, right? So by having two separate apps, a Fubo Sportsbook app and a video app, ultimately we can link the two. So even if we didn't even get to a product integration, just having that data available and allows us, if you're watching LeBron James shoot a foul shot on Fubo and your account is linked, we can already send you a bet slip quietly without you even asking for it. And it's already sitting there for you to go. That type of data, that type of information, that ability for us to surface either the right video because you're betting on something, or surface the right bet for you, that is, in my opinion, relatively unique. Of course, I'm not saying others can't collaborate. That's great. But there are many ways to do this. And in my opinion, having that ability to leverage data on both sides, it's just a powerful way to create a very seamless experience.
So is what you're saying that DraftKings doesn't have that same ability with folks who are working with Dish? Do you know that they won't have that same capability?
I can't speak about other companies. I know that I went through this process and I had thought about, with our team, about do we collaborate? What can we do? Collaboration is tough. We own our own video stack. We built all the technology in-house. We continue to invest in our technology. And if you want to be an innovator in the space, again, this is in my opinion, look at Netflix, look at Spotify. These are companies that have amazing tech stacks. And despite every effort for everyone to kind of try and do what they do, they just do it better. And so by owning all of this allows you to continue to iterate. And our business has been built on iteration and A/B testing and doing that relatively quickly over time. That's been our playbook. Yeah. I'm not saying that there's any one right way to do it, but I believe the way we're thinking about this is the right way to think about it. And we have to go through a KYC process. Our customers will go through a KYC process. So, there will be friction there. But once we have...
Just to be clear, KYC meaning know your customer, it's banking regulations, anti-money laundering.
Yes, correct. So, and that type of friction, having two separate apps that eventually link, you don't really need to do much when you control all of that data in one area. Again, we're going to be regulated. We're embracing regulation. And we're, right now I would say we're at the forefront. That's not to say others won't do it. This is not a zero-sum game. I look at Fubo as an ARPU machine. And so for me, it's all about how do we add more revenue streams that create incremental viewership. Incremental viewership leads to better engagement. Better engagement, means, results in more advertising revenue. So for me, this is really about flywheel, and that happens under sort of one technology platform.
Okay. So what is it that folks in the market, because your stock, last time we talked, you guys were up like a rocket ship, and right now, I think you guys are kind of on the downslope and some pretty big moves down. What is it the market isn't understanding or isn't seeing about this unique advantage that you have? Why is the market thinking this DraftKings thing is a Fubo killer?
Well, because there's a lot, first of all, there's misinformation in the market. As you know, there are people that have said it's impossible, it's a fantasy, all kinds of phrases. And then you have validation from DraftKings and Dish that this is possible. There might be different iterations for different companies on how they want to approach it, but it is validation. I think the other thing is that we're a product company and a marketing company. And, people are looking at this in a way that isn't very creative. The whole point of us being regulated is so that we can understand and can have an informed opinion on how to build products. So I think what you're seeing with Fubo is we do what we say and we say what we do. At least that's what's been happening since our roadshow. We raised guidance 3 times in the last 3 quarters. We've over-delivered on all our KPIs. We told you that we were interested in wagering. We very quickly, within 60 days, acquired 2 companies that have rock stars that we're very happy with. That's going to allow us to really move quickly. And now we're actually giving you a date that we're going to launch in 4th quarter with wagering. We have 3 skins, one with multi-skin deal with Caesars. So, we're continuing to do what we do. All we can do is focus on our business. The growth rates are very high. And, I think it maybe 1, 2, 3 more quarters, but, eventually people catch on.
Okay. So as we're here right now, by the way, any news you do want to break since you left us hanging last time?
Look, I think our company pretty well. Like I said, we are focused on subscribers. We're focused on advertising. We're focused on getting our wagering business off the ground. And, we'll hope to make, more moves over the next couple quarters. But right now, I think we've put out enough information for people to chew on.
Okay. All right. Well, what about this? Last time we talked a little bit about licensing, the possibility for exclusive licensing. Any movement there you can tell me about?
Look, what I told you is what's happening. We're, it's tough not to look at it because you have a company like ours that did over $260 million of revenue in 2020. We are now guiding, to 77 to 78% increase at the midpoint to $465 million. So, as you get larger and you look at wagering and you think about the potential product opportunities, and so, you can't not look at it. So, but we're measured and very disciplined, and we've got a lot on our plate right now, and, we'll have to see.
All right, that was a very nice non-answer, David. I appreciate that. Very good. Last question I'll ask you is just about, the cost. Obviously, running a sports book as you guys are expanding, you talked about those 3 new deals. But again, the thing that I think jumped out at a lot of investors in your last earnings report was the cost, and it does seem like those costs are only going to rise. How do you guys control costs when you're doing a sports book, when you're acquiring companies, when you're doing all these things in order to kind of turn those things up? Or is your thought process that we spend the money now and the growth is going to come and that's the most important thing?
Yeah. So again, I can't say enough. This is a very measured and disciplined company. When you look at the actual cash expenditure, it's for the year it was like 220 to 230 million. That is not a lot of money given the fact that we're in a business that is driving significant growth and significant revenue. Our marketing budget at our stage, I think, is relatively light at 20% of total revenue. We acquired 2 companies that were small, companies that we could digest. So again, very measured, very disciplined. Rockstar teams allows us to further develop their technology and doesn't have any integration risk. And the fact that we're going into wagering in certain markets and calling out fourth quarter is because we want to be measured about it. We're not going to spend hundreds of millions of dollars on on marketing. Because we have to first understand what those integrations are going to be. How do we leverage? I mentioned that there are synergies around marketing. We already have a base of about 6 million people in our sort of credit card base of customers that are coming in and out. We have a service where we can market on our platform. So there's ways in which we don't have to go out and spend a significant amount of money. And I think the markets will reward us when they see our path and our plan and our very clear vision. And again, we've executed well in the last 3 quarters, continue to raise guidance. Our contribution margin has improved, as you know, and it has for 2 quarters. That's going to continue. So, again, measured and disciplined.
Measured and disciplined.
That's
all
the
right.
takeaway.
I don't know if that's what if the stockholders want to hear, if the stock market wants to hear, but it's a reasonable take for a reasonable company. David Gandler, CEO of FuboTV, thank you so much for being with us.
Thank you, Dion. Looking forward to next time.